Creating a budget is the first step in taking control of your finances and building your wealth. It's not how much you earn that will make you wealthy, but rather how much you can save. So by creating a budget, you can identify where you are spending your money today, and more importantly, where you can choose to start saving. Regardless of how old you are, how young you are, how much you earn, creating a budget is the first step in managing your finances. A great habit to get into is, in your regular pay, putting aside an amount right at the very beginning. Before you pay your landlord, your mobile phone bills and go to the grocery store, put aside some money into a separate account that you can't access at the ATM, and that can be the beginnings of an emergency fund or the beginnings of a deposit. It's for you in the future, and we call it pay yourself first.
Most credit cards have high levels of interest. So one of the reasons why it is good to pay off your credit cards as soon as you can is for no other reason than you actually want to save interest on the interest that you're being charged on the outstanding balance. So if your credit card is charging you 15% per annum interest, which is a fairly typical fee at the moment, $1,000 worth of credit card debt is going to see you paying $150 a year in interest for that unpaid account balance.
Paying your home loan off more frequently is a really good way to save money. By way of example, if you had a $250,000 loan at, say, 5.75% interest over a standard 30-year term, and you paid that off with monthly payments at $1,460 a month, then you'd spend around about $275,000 in interest over that 30-year term. Now, just by changing it to a fortnightly payment, you'd reduce that total interest over the term to around about $218,000, and therefore saving around about $57,000 over the term of that loan.
Many people have multiple superannuation accounts. The average Australian has about 5 different superannuation accounts. So you need to amalgamate those, reduce the fees so that you have a higher balance when you actually retire. So the way to amalgamate all of these is to go to the tax office website. They have what's called a super seeker option on their website. You need to click on that option and find all of your lost super accounts and amalgamate them all into your preferred superannuation vehicle so that you have more money together for your retirement.
There's a whole lot of money sitting in bank accounts that haven't been accessed for many years. That money is getting pooled into an unclaimed money account. The MoneySmart website has online tools to help you identify if you have such lost accounts, and you can reclaim your money back.
Having private health insurance does save tax because there's what's known as a Medicare levy surcharge on higher income earners, and that starts off as low as $88,000 a year as the threshold for a single person, and if that person doesn't have private health insurance, then they pay an extra 1% tax on their taxable income as a Medicare levy surcharge. Now that also increases, over $102,000 a year is 1.25%, and over $136,000 a year it's 1.5%. So for a family situation, those thresholds are doubled, but they could be paying up to around about $4,000 extra tax by way of a Medicare levy surcharge, and if they don't have private health insurance. Salary sacrificing is a great idea to build on retirement savings. It allows the employee to effectively receive a tax deduction for their superannuation contribution because it's paid out of pre-tax dollars by the employer. Because of that, they have more money to invest, and invested inside superannuation, it's only being taxed at 15%. So it's a wonderful structure to hold retirement savings inside superannuation, and it will build much more quickly than if an investment held in your own name outside of super.
It's a good financial planning strategy to put a small amount of money, maybe even just $10 a week, into your superannuation while you are in the early years of work, and you'll then have that savings for you later in life when you finally stop work and you have to fund your own retirement.
Everyone assumes that everyone else knows exactly what they're doing with their finances and that you're the only one that just doesn't get it. The important thing is to ask questions. Your accountant, your financial advisor, your friends and family can all give you great advice on how to take control of your finances and, importantly, make smart decisions.